Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
I'm Alex.
And I'm Jamie.
So it's mid-December, and if you look at what's just landed on our desks, it really does feel like the regulators are clearing house before the holidays.
Clearing the decks, absolutely. But they're doing it with what feel like profoundly contradictory messages.
Exactly.
On one hand, you've got these huge moves toward deregulation, towards flexibility. The PRA is deleting reporting forms. The FCA is rewriting investor rules for growth.
And then, simultaneous to all of that, we get hit with one of the most substantial financial crime penalties of the year.
That tension is exactly why we need to do this deep dive. The FCA is signaling it wants firms to innovate to cut the red tape.
And it's a huge but. Operational control failures, particularly around fin crime and, culture, they are now being penalized with, well, absolutely stunning severity.
So our mission today is to unpack this high-stakes environment. We need to get into the chilling details of that nationwide fine.
Then look at the ambitious, but maybe strategically flawed, 10 million investor rewrite.
And then finally get a realistic handle on the Q1 2026 compliance wave that is now very, very rapidly approaching.
Okay, so let's start with that iron fist. The fine handed down to Nationwide Building Society is genuinely staggering.
It is. It was reduced from, what, nearly £63 million?
For early settlement, yes. But the final penalty still stands at $44.078 million for AML failures, and this stretched across a 5-year period.
What makes this so potent, I think, is that it's not abstract. The FCA's final notice, it zeroes in on one unbelievable failure.
The headline figure.
$26 million in fraudulent COVID furlough payments were laundered through a single customer account.
In just 8 days.
8 days. That figure alone should tell every chief risk officer, every compliance team listening, that the systems they think are robust are being tested at speeds they just might not be prepared for.
Absolutely. This wasn't just a paperwork error or some kind of minor systems glitch. The FCA determined this was a fundamental failure of control culture, a breach of Principle 3.
So practically speaking then, what were the systemic failures that let this go on for 5 years?
The FCA cited 3 specific, really critical gaps. The first was inadequate customer due diligence refresh cycles.
Okay.
Nationwide just lacked effective systems to make sure that customer knowledge was, kept current.
So existing customers, onboarded years ago before rules were tightened, were just left.
Effectively, yes. They weren't being properly reviewed or re-risk rated, and that prolonged vulnerability is key.
What was the second gap?
The second was monitoring, and here the source material is, well, it's damning. Internal reports noted the existing transaction monitoring rules were, and I'm quoting here, narrow in focus.
And the alert thresholds were set very high.
Very high. In fact, consultants they brought in assessed Nationwide's monitoring maturity at stage 2 out of 5.
2 out of 5. And their peers.
Amalgamated peers were already at stage 4. That signals a material gap, between their defenses and the industry standard.
So this isn't about just meeting the minimum. The FCA expects firms to be proactively benchmarking against the best in the sector.
That's the message. And the third failure, which I think speaks most loudly to that cultural critique, was the business use blind spot.
So personal current accounts being used for business activity.
Exactly. Contrary to their own terms and conditions. And the FCA noted this risk was tolerated for nearly 2.5 years.
2.5 years.
The final notice even says that by May 2020, Nationwide records showed they knew around 5,000 personal accounts had received COVID payments.
Which is a strong indicator of business use on the account.
The delay in taking impactful action is what truly convicted them. The takeaway here is that this $44 million fine proves the FCA is looking beyond the tech. It's focusing on how a firm responds to known risks.
You have to use this as a checklist now. Benchmark your own fin crime frameworks against these specific failures.
Definitely. Okay, so having covered the heavy stick of enforcement, let's pivot to the carrot.
The areas where the FCA is actively trying to cut red tape and promote growth.
And the big one is the long-awaited overhaul of the MiFID client categorization rules. Specifically for the elective professional investor. It's finally here.
Right. This is the streamlining agenda. They're ditching that rigid, complex, EU-era quantitative test.
One that caused so many compliance headaches, yeah.
Oh.
And they're introducing 2 more flexible pathways for an individual to get professional status.
And one of those pathways, the new alternative wealth assessment, has really raised some eyebrows, hasn't it?
It has. To qualify using the simplified quantitative route and to opt out of retail protections, you must have at least £10 million in investable assets.
10 million.
That's the strategic twist. While it's meant to provide flexibility for the truly sophisticated investor, that bar is deliberately set incredibly high.
So they're trying to combat those historic poor practices where clients, say in the £1 to £5 million high net worth range, were being inappropriately opted up.
That's it. The regulator is implicitly saying they no longer trust a firm's qualitative judgment for anyone below that 10 million mark.
It forces the vast majority of high net worth clients to go through the more holistic, rigorous, qualitative assessment instead.
Exactly. You can't just rely on a simple balance sheet check anymore for most of your wealthy clients. And that level of reassessment, it comes at a cost.
Not just in staff time.
No. We're looking at an estimated industry-wide implementation cost of $32.3 million.
Wow.
Largely because firms have just 1 year from the rules commencing to review and recategorize all of their existing elective professional clients. That's a huge resource drain.
Especially coming right alongside Basel 3.1. And we see similar simplification in insurance, don't we?
We do. Policy statement PS 2521. It's just the focus from, prescriptive timekeeping to outcomes.
The major change here being the removal of the mandatory 15-hour CPD requirement for insurance distribution staff.
Yeah, but the FCA clarified this isn't a relaxation of standards. Competence is still mandatory. It just pushes the onus back on firms to design tailored training rather than just checking a box on hours spent.
They also got rid of the minimum 12-month product review for non-investment insurance.
Which is a very welcome move. It's outcome-based. It trusts firms to manage risk rather than just dictating the clock.
Okay, let's move on to maybe the most transformative but also risk-laden piece of reform, the new targeted support regime.
Designed to finally address that consumer advice gap, which currently affects, around 23 million people?
We've got near final rules now in PS 2522 and a hard timeline. The gateway for applications opens March 2026.
And the rules are expected to take effect on April 6, 2026.
The ambition here is massive, allowing firms to give ready-made suggestions to predefined consumer segments. But crucially, this is not advice in the personalized sense.
Precisely. Targeted support is explicitly not subject to the highly personalized COBS 99A suitability rules.
So the firm has to ensure the suggestion is suitable for the group, but they can't use assumptions that are material to an individual suitability.
It's a very delicate line to walk, which is why the consumer protection framework around it is so important.
And that, thankfully, has been well received. The FOS and the FSCS have confirmed strong coverage, treating it similarly to protected investment business.
That consumer confidence is vital. But the FCA has also imposed some very specific critical restrictions.
To prevent firms pushing customers into high-risk, irreversible decisions.
Exactly. So firms are expressly prevented from recommending pension consolidation, for example. That requires a deep individual assessment.
And they can't recommend a particular annuity product either, only suggest general features or access, which seems sensible.
Very sensible. But let's talk about the business model tension here, because this has huge implications for who can actually enter this market.
You're talking about the FCA's decision not to require disclosure of cross-subsidization.
I am. It simplifies the consumer journey, sure, but the strategic consequence is that it massively benefits large, vertically integrated firms who can absorb the costs elsewhere.
Potentially chilling the very fintech innovation the regime was meant to encourage.
Right, because most people agree uptake will be limited unless the service is provided free at the point of use, and for smaller firms trying to innovate.
The barrier is significant. The permanent minimum capital requirement for providing targeted support is set at £500,000.
£500,000? That's a serious hurdle. It certainly looks like the FCA is signaling that only highly capitalized players should be in this space.
It reflects the scale of potential customer harm if these mass market suggestions go wrong.
If you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
So, moving from the rulebook to the macroeconomic landscape, we've seen a rare and, I think, significant public disagreement between the Bank of England and the Treasury.
It's not just political theater, is it? This goes right to the heart of the UK's growth strategy and affects every retail bank's lending models.
The disagreement was over employment strength. The bank's Catherine Mann publicly contradicted the Chancellor's claims of strong employment growth.
Yeah, her argument was all about the cost drivers hitting employers right now.
She specifically cited the government's $26 billion national insurance tax raid.
Combined with the minimum wage increase, it's a huge cost push, forcing employers to make very difficult choices about headcount.
And she used that really striking analogy, didn't she? The pig and the python.
She did. She said, I've called it the pig and the python. Firms are digesting these costs, but half of them say we have to reduce employment, and that's according to the bank's own analysis.
That's crucial for banking strategists. When a senior BOE rate setter is publicly warning that government tax policy is leading directly to planned job cuts.
It paints a picture of underlying fragility that has to feed immediately into your credit risk assessments and provisioning models.
And this caution comes alongside data showing subdued consumer spending.
Exactly. November's sales growth was the weakest since May, driven by falling non-essential spending.
So when job security feels low and essential costs are rising, unsecured lending risk just goes up dramatically.
The whole macro picture is telling retail banks to be very cautious about the consumer for the start of 2026.
Okay, let's switch gears to the future of finance. It's now abundantly clear that digital assets, and specifically sterling stablecoins, are a top priority for 2026.
The shift in institutional attitude is, well, it's nothing short of profound.
The FCA's Nikhil Rathi confirmed it's a major focus. But the biggest signal came from Wall Street, didn't it?
It did. Jamie Dimon, the JP Morgan CEO who famously called Bitcoin fraud, now says crypto and stablecoins are real digital assets.
And they're not just acknowledging them. They anticipate JP Morgan planning for trillions in daily payments on tokenized ledgers.
Trillions. This signals that tokenization is moving from some experimental fringe project to the absolute core of institutional banking, and very, very quickly.
So how is the Bank of England preparing for this massive technological shift from a stability perspective?
Well, they're applying a comprehensive risk framework. They're mapping stablecoin risks onto three very familiar channels: leverage, liquidity, and interconnectedness.
And they're specifically focusing on the bank coin nexus.
And the sovereign coin nexuses, essentially, it ensures they don't have to wait for bespoke data. They can apply lessons learned from past market crises right now.
And the need for these stringent controls is just obvious when you look at the market's recent past.
Absolutely. We have to remember why this urgency exists. It's underpinned by incidents like the $40 billion crash of Terra USD.
And the 15-year prison sentence for its co-founder, Du Quan, for what the judge called fraud on an epic generational scale.
That context makes it entirely appropriate for the bank and FCA to be focusing so hard on this right now.
Okay, let's draw this all together. We've seen regulators offer flexibility and efficiency.
Removing 37 PRA reporting templates, streamlining insurance CPD.
But at the very same time, they've hammered a firm with a massive fine for operational sloppiness.
And that really sets the stage for Q1 and Q2 2026, which is shaping up to be an absolute resource crunch for compliance teams.
The convergence is undeniable. Firms are facing the simultaneous landing of multiple high-impact programs.
We are talking final rules for Basel 3.1, that one-year deadline to reassess all your elective professional clients.
And the targeted support regime going live in April 2026. These are not projects you can wait until the new year to resource.
The central message from the regulators is crystal clear. You get efficiency, you get flexibility, but the cost of an operational control failure,
As that $44 million fine shows,
is higher than ever before. It's an environment that demands both strategic vision and immediate tactical precision.
it does. The FCA is signaling that while it won't prescribe how you manage every process, you must be able to prove holistically that your system is robust.
And here's a final provocative thought for you to take away. Given that high 10 million threshold for the new professional client rules, how many of your existing elective professional clients today will still qualify under the stringent new qualitative assessment if they don't hit that wealth marker?
That is a crucial risk management and legal liability exercise that has to start now.
That's all from us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp and stay compliant.